The Affordable Care Act Premium Tax Credit Cliff is back for 2026. And if you're not planning ahead, you might just fall right off of it. Many of the folks that we serve in our practice are looking to retire before a normal retirement age, let's say 65. But as a result, healthcare costs is always a top concern because they're not yet eligible for Medicare until they turn 65. So Healthcare.gov, or formerly known as Obamacare, is generally where folks go to shop for private insurance until they become eligible for Medicare. But that initial premium can be a little bit of a sticker shock until they realize that by controlling their modified adjusted gross income, they could put thousands of dollars back in their pocket in the form of these premium tax credits. In this video, we're going to discuss who might qualify for those premium tax credits, how they work, and then finally, we're going to talk about those key tax planning opportunities as the current rule sunsets in 2025, and then the cliff comes back in 2026. But first, for those of you who are new, my name is Kevin Lau. I'm the host of the Planning for Retirement podcast, and I'm also the owner of Imagine Financial Security. We help individuals over 50 with at least 7 figures saved to maximize their retirement spending, minimize their lifetime tax bill, and worry less about the financial markets. If that describes you, make sure to follow our podcast and also make sure to subscribe to the YouTube channel. We put out weekly retirement-related content specifically designed for you, who I like to call PFR Nation. And listen, I know this retirement planning thing could be complicated. So if you're interested in getting a second set of eyes and potentially working with our firm, you can visit us at www.imaginefinancialsecurity.com, or you can fill out the retirement readiness questionnaire that is linked in the description. We'd love to help you plan for and execute your ideal retirement. So I did a video a couple of months ago before the One Big Beautiful Bill Act became law on July 4th. And so if you watched that video, you probably know a little bit about how these premium tax credits work. But if you haven't watched that video, I'd recommend going back and taking a look at that one as well. I will link that at the end of this one. But in general, I mentioned that I had a prediction at the end of 2025 that the old cliff was going to come back. And what I mean by that is there used to be a hard stop. Once you earned over a certain dollar of income, you were no longer eligible for any premium tax credits. Well, with the American Rescue Plan that was passed in 2021, essentially the COVID relief package, one of the COVID relief packages, they made it into a gradual slope. They made these premium tax credits a little bit more available for Americans, essentially trying to stimulate the economy a little bit during the pandemic. Okay, but at the end of 2025, that slope was set to revert back to the cliff. With the One Big Beautiful Bill Act not addressing this in particular, that means that we are back to the cliff starting on January 1 of 2026. So we're going to talk about why that is important, especially for folks that are planning for an early retirement before the normal age of 65 and they're not yet eligible for Medicare. So the first slide that I have pulled up here is what this is essentially your expected contribution. What this means is your expected contribution as a percentage of your income to health insurance premiums, okay? And this is going to determine how much tax credit you're eligible for. So what they do is they take the benchmark plan, which is the second cheapest silver plan. So these plans are broken down from bronze, silver, gold, and platinum. So bronze plans, highest deductible, lowest premium, okay? Up to the platinum plan, which is the lowest deductible, highest premium. Okay, so they're looking at the silver plan and they look at the second cheapest silver plan. And each state has their own premium. So you're going to have to, what I always recommend people do is go to Healthcare.gov and kind of play around with it. You don't have to apply or do anything. You can just put in your name, put in your age, put in your marital status, put in the number of people in your household, because that's all going to impact how much of premium tax credit you might be eligible for. But what I have is the expected contribution as a percentage of your modified adjusted gross income for 2025 and for 2026. So what you'll notice right off the bat is that across the board, every single band of income, so you look at these as income bands, every single one across the board from 2025 to 2026 is going up, okay? What that means is the premium tax credits across the board are going to be a little less generous, even if you qualify for them. Okay, so we already talked about the hard cliff. Okay, and I'm going to point to that here in a second. So as you can see at the very bottom, we have the band over 400% of the federal poverty line. Okay, where in years past, prior to 2021, okay, we had this unlimited contribution percentage, which meant it didn't matter what the premiums you were paying as a percentage of your modified adjusted gross income, you were not going to receive any premium tax credits for these particular policies. However, in 2025 and starting in 2021, there was this gradual slope, meaning even if your income was above this 400% of the federal poverty line, that's what FPL stands for, by the way, is the federal poverty line, which we'll talk about in just a second. Even if it was above 400% of the federal poverty line, if your contribution percentage exceeded 8.5% of your modified adjusted gross income, you're going to receive some premium tax credits. Okay. And that was a big change. And I did that on the whiteboard fireside chat that I mentioned before, the one I did a couple of months ago. This couple in the state of Florida could earn up to $300,000 of modified adjusted gross income and still qualify for some premium tax credit. And so 2026, we're going back to the hard cliff. Once your income exceeds 400% of the federal poverty line, you're no longer going to be eligible for these premium tax credits. So it really makes tax planning super, super important, especially for early retirees if they want to maximize these. It's not going to be important for everybody, but for many of you, you want to keep your healthcare costs as low as possible during those early years of retirement, and this is one way to do that. So a couple of things as a summary here. Expected contribution percentage is going up across the board, which means premiums are going to go up across the board, net of those premium tax credits, and then that hard cliff is going to begin starting in 2026, just like it was in place prior to 2021. I will also note that open enrollment period begins on November 1, and so we don't know what the premiums are going to be for 2026. We'll know those once open enrollment happens, but it's very likely, just on the research that I've done on this, it's very likely that you will be experiencing a double-digit increase in your premiums. Okay, so this has nothing to do with how much in premium tax credits you're getting. This has nothing to do with expected contribution percentage. It's simply because healthcare costs are going up, costs of labor are going up, inflation, tariffs. There's all these factors coming into play on top of these uncertain legislative impacts. Essentially the expectation for a lot of these insurance companies is once the cliff comes back in 2026, many of the healthy people are no longer going to be eligible for these premium tax credits. So they're going to cancel their ACA policy and they're going to maybe go buy a policy directly through an insurance company, not on the ACA. So that is the concern. And so ultimately, the people that are going to be left inside the Healthcare.gov or these ACA policies will be the unhealthier demographic of the population. So therefore, the cost of these policies are going to go up. So there's a lot of uncertainty in terms of how much they're going to go up by. But if I were to make a prediction on this one, I'm going to say on average between, let's say, 15 to 20% increase in premiums alone in 2026. We'll see if I'm right on that one. The second thing we want to look at here is the federal poverty line. Like, what is this number? So what I have here on the whiteboard is the federal poverty line for DC and all of the states except for, I believe, two, and that is Alaska and Hawaii. I think they've got a slightly higher federal poverty line number, not by a lot, okay, but just by a little bit. Well, but what I have here is where most of you will reside, and it breaks down what the federal poverty line is based on your household size, okay? And that's the most important thing is each member you're adding to your household, the federal poverty line goes up. Makes sense. So if you're single and let's say you're 60 years old, the federal poverty line, and you live in one of those states or DC that I mentioned before, your federal poverty line target is going to be $15,650. So the range in terms of whether or not you might qualify for premium tax credits is 100% to 400% of this number here, okay? If you are a married couple and you have no other dependents on your tax return other than the two of you, then we're going to be looking at this number here. Okay, so the $21,150, and you'll do the same thing. Multiply that by 1, upwards of 4, and that's your the range in terms of okay, what is your modified adjusted gross income, which we'll talk about here in just a second, and then what income band did you fall in? If you were let's say between 200% to 250% in 2026, your expected contribution rate is going to be somewhere between 6.6% to 8.44%. So again, what they'll do is they'll take that second cheapest silver plan, compare that to the percentage of out-of-pocket costs without any premium tax credits for that particular premium, and then that's how they're going to calculate what your tax credits will be for that year. Now, I will say, this the premium tax credits are in advance. Okay, the default option is in advance, so essentially it's going to reduce your monthly premium. So let's say let's say the sticker price on a policy you're looking to purchase is $2K a month. Okay, but then your let's say that's the premium, but let's say your tax credit, let's call it PTC, premium tax credit, equals, let's say it's $1,000 a month. Okay, so your net out-of-pocket cost is going to be $1K a month. So the default option is you essentially take this $1,000 a month and you reduce your premium. Now, the risk on this one is if you are totally wrong with your modified adjusted gross income calculation, a projection in a bad way, meaning you under projected what your modified adjusted gross income is going to be for that year, then you're very likely to owe a lot in taxes come tax time. Okay, so it's better to be a little bit on the safer side, a little conservative. Okay, so therefore you might get a little bit of a lower monthly premium advance, and then you can rectify that tax impact when you file your tax return that following year. Okay, but it is an advance, but you don't have to take it as an advance. You can take part of it. You can say, you know what, the $1,000 a month is what I think I'm going to be eligible for, but give me only $500 a month. I'll pay $1,500 a month of my premium. Give me we'll kind of set aside. I'll pay that other $500 a month out of pocket. And then come tax time, I'm hopeful I'll get another $6,000 back in the form of those premium tax credits. However, I built in a little bit of a buffer there. On the flip side, you might say, don't give me any of the premium tax credits. I'll kind of use that as a forced savings vehicle. And then when I file my taxes for that following year, then I'm going to rectify what those premium tax credits I might be eligible for, what those actually are, because I know what my modified adjusted gross income actually was for that particular year. So just know that this is a projection forward, and it is in advance if you select it like that, okay? Which is definitely the most popular option because it's the default option. It reduces your monthly cost, and then you essentially you sort of do the checks and balances at the end of the tax season. Now, what is this modified adjusted gross income number that I'm mentioning? Okay, so you may have heard me mention this several times on different whiteboard fireside chats or different podcasts, but modified adjusted gross income is different than your adjusted gross income, and it's definitely different than your taxable income. But really, if you want to simplify it here, I do have all of the sources. This is everything that is counted in your modified adjusted gross income calculation. This is everything that is not counted. Okay, so you add all these up. But really what this is, it's really your adjusted gross income. And then you're going to add back a few things like the non-taxable portion of your Social Security. So let's say you're 62, you're starting Social Security, but let's say a good chunk of that was not taxable because, you may know that up to 85% of your benefit could be taxable, but could be closer to 0% taxable. Okay, so you need to add back any income from Social Security that was not taxable. You need to add that back. Okay, you also need to add back certain foreign income. So if you're receiving foreign income from a business or some investment that you have, some partnership that you have that's typically excluded on your adjusted gross income, you need to add that back. But one of the most popular ones is going to be a special kind of investment income related to municipal bonds. Okay, many of the folks we serve are in higher tax brackets, so it's definitely an option to look at investing in municipal bonds versus taxable bonds, because municipal bonds are actually tax exempt at the federal level, and then they could be tax exempt at the state level if you invest in certain state and local municipalities that you reside in. Okay, but that is added back, so that is a number that is added back on your modified adjusted gross income. So even if you're kind of thinking, hey, I'm investing in munis, I have no interest income on my adjusted gross income, you need to add that back for this modified adjusted gross income calculation. So that is one key thing to note, is that when they're looking at these ACA premium tax credits, they're looking at your modified adjusted gross income, which is basically adjusted gross income, add back your foreign income, add back non-taxable Social Security, and add back tax-free interest from municipal bonds. That's in short how you want to look at it, but if you want to pause the video and go through all these, you certainly can. But in this video, we're going to focus in on some key planning opportunities to keep your modified adjusted gross income as low as possible so you don't fall off the cliff, and that you could potentially maximize your premium tax credits for 2026 and beyond. What I will mention before we move on to those tax planning opportunities is that nothing has changed for 2025. Even if you are above that 400% of the federal poverty line, as I stated earlier, they're going to look at your expected contribution as a percentage of your modified adjusted gross income, which is going to be 8.5%. Okay. So again, you could still qualify for these premium tax credits in 2025, even if your income, your modified adjusted gross income is above 400% of the federal poverty line. But then next year, no more because of this unlimited expected contribution percentage. Really, really key. All right, let's talk about some tips to reduce your modified adjusted gross income. One of the core themes that we focus in on for all of our clients, regardless of what life phase they're in, regardless if they're looking for these premium tax credits or not, is a tax efficient withdrawal strategy. Because at the end of the day, the clients that we serve, they typically have different pots of money that they can pull from. They've got the taxable bucket, they've got the tax deferred bucket, they've got the tax free bucket. Okay. And there are different levers that we can pull within each of those buckets to optimize for this tax efficient withdrawal. Okay. However, if we're really honing in on maximizing these Affordable Care Act, these ACA Premium Tax Credits, you might want to start with taking distributions out of that taxable bucket first, because you've already paid taxes on those contributions into that bucket. Okay. You might have some capital gains in there, but that might be a small fraction of the overall portfolio size. And ultimately you can do some smart strategies along the way to minimize those capital gains, which we're going to talk about here in a second. But ultimately what you could do is really focus in on withdrawals from cash accounts. Maybe you've got a year, 2 years of income sitting in cash or checking, like savings accounts or money market accounts. Ultimately, you could just take distributions out of those accounts to supplement any other income source you have to satisfy your retirement income goals. You're not going to pay any taxes on that. You'll pay taxes on the interest that you earn, but you're not going to pay taxes on any of those withdrawals like you would if you took a withdrawal from your IRA or 401k that has been growing tax deferred for all these years. Then you could also focus in on withdrawals from your brokerage account, which is also the taxable bucket. But like I mentioned, if you have, let's say you contributed $500,000, that's your cost basis, but the value is $1 million, you have a gain in there of $500,000. But what you can do is you can select what shares you're liquidating in order to generate that income to minimize the amount of capital gains taxes that you could pay on those withdrawals. So even though you're withdrawing, let's say $100,000 or $200,000 on an annual basis from the taxable brokerage, you might only pay taxes on $30,000, $40,000, $50,000, depending on how you structure those withdrawals from your investments. Super tax efficient way to take out income during that bridge period until you become Medicare eligible. Now, the second strategy I want to point out here is also, it goes hand in hand with that first strategy, and this is tax loss harvesting. So tax loss harvesting involves selling something at a loss intentionally. Okay, you've probably heard the notion you want to be buying low and selling high. Well, with tax loss harvesting inside of a brokerage account, you actually want to go ahead and sell something at a loss to realize the losses. Because if you have a loss on paper, that doesn't do you any good from a tax standpoint until you sell that investment and now you've realized that loss. But then you might kind of say, hey, you know what, Kevin? Well, what if I miss out on the market? What if the market recovers? Let's say we're sitting, Liberation Day, April 2nd, 2025, the market all of a sudden goes down upwards of 20% over that period of, let's say, 4-ish weeks. Well, hey, there were some tax loss harvesting opportunities that we took advantage for our clients. But then the question is, hey, what if the market recovers? Which it has, by the way. Well, what you do with tax loss harvesting is you realize that loss on paper by selling that investment, and then you turn around the next day, the next minute, the next week, whatever it might be, but very quickly you turn around and reposition and buy or replace that security with another security that's not substantially identical. So you couldn't sell, let's say it was Microsoft. Let's say you had a loss on some of your shares of Microsoft. You couldn't sell Microsoft at a loss and turn around and buy Microsoft within a 30-day period. This will trigger the wash sale rule. So what you do is you turn around and replace that with something that's similar. So maybe you don't replace it with Microsoft, but maybe you replace it with IBM or Apple, another tech stock that kind of looks like Microsoft, but that's not substantially identical. An easier way to do that, if you have an exchange traded fund or a mutual fund, is you replace it with another fund that's similar, has the similar characteristics, but again, that's not substantially identical. So you don't want to trigger the wash sale rule. And as long as you don't, you can then use those losses to offset any capital gains, like we mentioned in that bullet point number 1. So even if you're doing those tax efficient withdrawals, you might have some capital gains on an annual basis when you're making those distributions. However, if you've got a war chest of tax losses that you have on your tax return, because those can be carried forward on an unlimited basis, you can use those losses to offset gains in the future. That's why it's super important when you have periods of volatility, like 2022, like Liberation Day in 2025, like the pandemic of 2020, 2008, 2009, all great opportunities to tax loss harvest. Very difficult to do it because it does involve some active management during periods of volatility. And oftentimes during periods of volatility, people want to just bury their heads in the sand. This is why, when we're managing our clients' assets, we have discretion. We have full authority to make the trades. So while they're out playing golf or traveling with their family members, they may be worried about what's going on when the markets are volatile, but they know our team on the back end is implementing these strategies for them and realizing those tax loss harvests. They're going to be very, very surprised, our clients, at the end of 2025 when they see some of the losses that we harvested in April of 2025 this year in order to offset either gains this year or gains in the future. And if you have no capital gains, by the way, you can use up to $3,000 as a deduction against your ordinary income that particular tax year. All right, number 3 I put on here is this concept of asset location. And, you've heard this term in real estate before. It's all about location, location, location. Well, from a financial planning standpoint, it's also about where you own certain investments. Do you own those investments in your brokerage account, which is taxable? Do you own those investments in a tax-deferred IRA or a Roth account that's tax-free? Okay. This is one of the most important concepts when it comes to minimizing the tax impact of the investments that you own. I'll give you an example of what not to own in your taxable brokerage account. High turnover mutual funds. Okay. These are mutual funds that you might own, maybe one of the big fund families, maybe it's American Funds or T. Rowe Price, whatever it might be. These fund managers are constantly buying and selling securities throughout the year. Even if you're not buying or selling any of those securities, you haven't redeemed anything to take a distribution, other investors in that fund have. And they also have their own investment and rebalancing targets. So while they're buying and selling securities, they're building up taxes that they essentially pass on to you, the shareholder of those funds. So if it's a high turnover fund, ultimately, you're going to be responsible for a lot of taxes at the end of the year, even if you didn't do anything. So those high turnover mutual funds, I'm not a fan of in general, just because there's more cost-effective and tax-effective ways to invest in the markets in today's economy, in today's world. So don't own high turnover mutual funds in those taxable brokerage accounts. Another tricky one is taxable bonds, okay? Many folks own taxable bonds in the brokerage account, which I'm not saying don't do that, because there could be a good argument to have some bucket of funds that you're relying on during that bridge period until you hit Social Security or until you start taking distributions from your tax deferred accounts. But if you're overloaded in taxable bonds, maybe you've got a large brokerage account, maybe it's $1 million, and maybe $400,000 is inside of taxable bonds. You've got a 60-40 split. So all of a sudden, $400,000 is generating taxable interest, which now interest rates have come up. Let's call it, 5% roughly. Now all of a sudden, you're adding $20,000 of taxable interest on your tax return. And so asset location would say, you know what? It makes sense to have bonds as part of the portfolio, but maybe you don't own $400,000 in the brokerage account. Maybe you've got an IRA. Or maybe you've got a 401k plan. Maybe you own $100,000 in your taxable brokerage account, and the other $300,000, again, if you're looking at all of your assets holistically, the other $300,000 you would own inside of your IRA or inside of your 401k, because interest income, taxable interest on those tax deferred accounts, that's not going to show up on your tax return. So asset location is super critical when we're looking at the context of where to own assets. Do you own it in the taxable bucket? Do you own it in the tax deferred? Or you don't own that in the tax free? That can minimize the tax impact of some of these tax inefficient investments and also put more dollars in your pocket in the form of these premium tax credits. Now, the opposite of a taxable bond would be a tax-free bond. These are municipal bonds. And essentially what you're doing is you're investing in your state and local municipalities. And by doing so, they're giving you more favorable tax treatment. There's no taxes on the federal level. And on the state level, they could also be tax exempt as long as you're using your own states or local municipalities, municipal bonds. But as we've already looked at, when you retire and you're looking at early retirement healthcare options and you're looking at policies on the ACA, that municipal bond interest is added back on your modified adjusted gross income calculation. Additionally, it's very possible that all of a sudden your taxable income has gone way down anyways. And generally, if you're in a higher tax bracket, let's say you're in the 35% bracket, okay, or the 37% bracket, there's more of an argument to owning those municipal bonds because of that tax savings. Because generally speaking, tax-free bonds have a lower interest rate or a lower coupon relative to taxable bonds, but because they're tax-free, that net of taxes return is going to be higher than a taxable bond if you're in one of those higher tax brackets. But if you retire, your income goes way down, you no longer have employment income, and all of your income is in capital gains or maybe a little bit of interest income or dividends, your income may go way down, and therefore it actually may not help you to own those municipal bonds anymore. So it could be a great rebalancing opportunity to take some of the distributions by selling those municipal bonds and repositioning some of those taxable bonds or more tax efficient investments in general within that taxable brokerage account. Not saying blow out all your municipal bonds. However, you need to really look at the net of tax return comparing both municipal bonds and the taxable bonds to see if those municipal bonds still make sense, because they're not going to help you when it comes to this particular calculation for that modified adjusted gross income. So another tricky retirement related issue is this idea of an emergency fund, because when you're working, the rule of thumb out there is, own 6 months or 12 months of your expenses in a money market account or some sort of interest bearing account that's liquid, but that's not tied to any market volatility. That way, if you get laid off or you lose your job or you have to resign for whatever it is, for whatever reason, you can take that cash, access that cash without any penalties, without any tax implications, and at least live on that for maybe 3 or 6 or 12 months. But once you retire, in theory, you're financially independent. So you really don't have that risk isn't really on the table anymore in terms of, hey, if you lose your job, it doesn't matter. You're not working anymore. You should be 100% reliant upon your assets and other income sources to be financially independent. So this idea of an emergency fund is a little bit different in retirement. I think it's more of a peace of mind fund than anything else. Okay. And this idea of, keeping 2 years or 3 years in cash reserves might be a little bit overkill, because let's say you're keeping, $300,000 in an emergency fund and now it's paying 4% interest. Well, all of a sudden, just by you having that emergency fund, you're not even using it, because the $300,000 emergency, what is that going to look like in retirement? I can't really think of anything that comes up, that might cost $300,000, maybe an unexpected healthcare cost, but that's why you have health insurance. Long-term care costs, that could be 20 to 30 years down the road. So maybe you invest that in a taxable brokerage account that's not spitting off interest income. Maybe it's more growth oriented. But let's say it's earning 4% interest, which I think is pretty conservative. All of a sudden, you're adding $12,000 on an annual basis in additional interest income that's on your tax return. Didn't really benefit you, okay? Because again, you're not using it. Certainly, you earned that $12,000, so that's great. But is there a better place to earn that interest income? Like we mentioned earlier, inside of that IRA, inside of that 401k, where that interest is not going to be taxable. So even if you have this peace of mind fund goal for this emergency fund in retirement, you really need to think about, okay, how much do you really want to keep in cash? And how is that going to impact your tax planning for that particular year? Does that limit the amount of distributions you can take in your IRA? Does that limit any sort of Roth conversion strategy you might have? Those are the things that you really need to be thinking about if you have a large emergency fund that's sitting in cash. Okay, number 5 is really this idea of optimizing Social Security. Now, I'm not going to tell you to delay Social Security just to avoid paying taxes on Social Security right away in order to maximize the premium tax credits. However, if you have other income sources, let's say you have a large taxable brokerage account, and let's say it might benefit you to delay a little bit. Maybe it's until your full retirement age, or maybe it's until 70, better yet. If there are arguments from a longevity standpoint that might say, you know what, it could make sense for you to delay Social Security, maybe you don't rush into claiming Social Security as early as possible at 62 or 63 or 64, because as we mentioned earlier, that income is added to your modified adjusted gross income, which could absolutely impact the amount of premium tax credits that you're eligible for. So again, Social Security is one of the more complicated decisions when it comes to retirement planning. You need to integrate it with the rest of your strategy, your withdrawal strategy, your conversion strategy, your longevity plan, okay, surviving spouse. I mean, there's so many things to optimize on that front. So, but I'm just saying, Social Security income is calculated as part of that modified adjusted gross income calculation. So you need to weigh that at least as one factor. All right, Roth conversions are also going to be a little bit tricky now, okay? Because before, during 2021 through 2025, we had this gradual slope. So even if you were doing some modest conversions and your income is a little bit above that 400% of the federal poverty line level, it still makes sense because long-term, you want to really maximize the benefits of those conversions. Maybe you're doing that for tax-free legacy. Maybe you're doing that to get ahead of required minimum distributions. The tax trap of 401ks or IRAs is what I like to call it, okay? However, with the cliff coming back, you might really want to be careful with this one. Maybe you want to be a little more conservative with Roth conversions if you want to maximize those premium tax credits before 65, and because Roth conversions are absolutely added to your income, and that doesn't really benefit you today. It's going to benefit you potentially decades or multiple decades to come, or even maybe your children, as beneficiaries. So I think really thinking through the Roth conversion decision is even more important for early retirees in 2026 and beyond because of the cliff coming back. All right, finally, IRA or HSA contributions, if you're eligible for those. Now, this is a little bit tricky because for an IRA, you must have earned income for the year. Okay, so if maybe you retired and you have income for part of the year, you might be able to contribute up to the maximum inside of an IRA, and that will reduce your modified adjusted gross income for this particular calculation. Same thing with an HSA. The tricky part, though, is you need to make sure you buy a plan that is HSA eligible within the exchange, okay? Now, I believe next year, starting in 2026, all bronze plans are going to be HSA eligible, whereas 2025 and before 2025, you had to kind of look within each plan description to see, hey, is this plan HSA eligible? So if you're starting with this right away in 2025, you need to look for those plans that are HSA eligible plans, and then you can contribute to that HSA. And then in 2026, I believe, don't quote me on this one, but all bronze plans are eligible for HSAs. But then there could be some other plans that are also HSA eligible. Again, you need to look into those descriptions as well. That's it for the tips, everybody. I hope you all found this helpful. And if you did, make sure to like the video and make sure to share this with somebody else that you think would find value in this. This is what we're looking to do. We want to impact as many people as possible. And like I mentioned earlier, if you're looking for a second set of eyes on your retirement plan, you want to figure out, hey, how do you maximize your retirement spending? When can you fire your boss? When should you take Social Security? How should you weigh the pros and cons of conversions versus maximizing premium tax credits? This is what we love helping people do on a one-on-one basis. So you can definitely start with the retirement readiness questionnaire that's linked in the description, or you can just go to our website directly at www.imaginefinancialsecurity.com to learn more. Until next week, this is Kevin Lau signing off.